All right, let's dive right into this explainer. We've got a massive mystery hiding in Synopsys' latest earnings, and honestly, it demands a full investigation. Something highly unusual just happened here. We're not just going to stamp this as a great AI company and universally call it a screaming buy, because the real problem isn't figuring out whether Synopsys is growing. We know they are. The actual problem is understanding exactly what kind of growth you're getting for your money. So we're going to unpack these results, strip away all the noise, and figure out if an undisputably great AI company is actually a great stock at its current price. 42.4%. I mean, that's the number that immediately jumps off the page, right? Synopsys just reported quarterly revenue skyrocketing to a massive $2.477 billion. To put that into perspective, last year that number was sitting at $1.74 billion. So at first glance, this seems like a no-brainer. AI is absolutely booming, chip makers are spending absolute fortunes, and Synopsys sells the exact software needed to make all of that possible. Case closed, right? Well, hold on a second, because there's another number hiding right beneath that top-line explosion that might just flip your whole perspective on this investment. Right next to that 42% revenue explosion, their adjusted non-GAAP earnings per share only grew from $3.39 to $3.91. That is an increase of just about 15.3%. And that brings us to the very first major piece of our puzzle. Why is there such a massive gap between these two numbers? Look, a $737 million increase in revenue is phenomenal, absolutely. But we really have to ask if the underlying business is actually growing faster than its profits, or if the recent mega acquisition of Ansys is severely skewing the data. We need to know if this is just some temporary accounting quirk, or if it reveals something fundamental about the underlying economics of the company. To crack this case, we first need to quickly ground ourselves in what Synopsys actually does. They operate in a space called EDA, or Electronic Design Automation. Think about the crazy AI boom we're in right now. To build one of those advanced chips, engineers have to design and verify literally billions of transistors, power systems, timing interconnects, and ridiculously complex packaging. Synopsys doesn't actually manufacture the GPU, and they definitely don't run the data centers. What they do is sell the shovels for the gold rush. They provide the highly complex, indispensable software tools required to design the silicon that is fueling this entire AI revolution. And that dynamic perfectly illustrates how the recent Ansys acquisition literally changed the game for Synopsys. Before the deal, Synopsys was already the dominant player in electronic design automation and semiconductor IP. But here's the thing, modern chips don't just exist in a vacuum. Advanced AI systems require engineers to simulate heat, electromagnetic behavior, signal integrity, the whole shebang. By absorbing Ansys, Synopsys essentially bolted world-class engineering simulation and multiphysics right onto their existing toolkit. Which leads us to a much deeper, far more strategic question. Did Synopsys buy Ansys simply because they wanted to buy more top-line revenue to impress the market, or did they buy Ansys to completely, top-to-bottom, monopolize the entire AI engineering workflow? Because if it's the latter, they're building an unbelievably sticky platform that modern chip makers simply cannot afford to bypass. But honestly, that exact acquisition is what's causing our massive numerical headache today. When you line up these three wildly different growth rates, we're looking at a genuine investor trap. I mean, revenue is up 42.4%. GAAP EPS is up a staggering 89.3%. But the non-GAAP, the adjusted EPS, is only up 15.3%. So which of these numbers actually tells us what Synopsys is worth? Because revenue shows us the scale. GAAP includes the full messy accounting costs, and non-GAAP strips out the expenses that management thinks are just distracting us from the core operations. So the crucial point we have to focus on is this absolute margin shock hiding in their fiscal year 2026 guidance. Management's guidance implies an adjusted non-GAAP operating margin of roughly 41.5%. And hey, that looks spectacular. But if you glance over at the GAAP operating margin midpoint, it's sitting at a meager 10.4%. Why on earth there's such an unbelievable gap between those two figures? The answer? It's all in the accounting reality of pulling off a mega deal. When a company buys an Ansys, it triggers an absolute mountain of expenses. We're talking massive acquired intangible amortization, heavy stock-based compensation, plus restructuring and divestiture costs. These expenses don't just magically vanish into thin air just because management slaps a non-GAAP label on the slide. As an investor, your job is to figure out which of these are truly non-cash expenses, which ones are going to keep recurring, and most importantly, which ones actually matter for your valuation. Now, let's pivot and look at the structural AI engine running behind the scenes because honestly, this is where the bullish thesis gets incredibly strong. AI doesn't just make chips popular, it makes semiconductor engineering fundamentally harder. Think of it like a chain reaction. As AI spending ramps up, we get a massive push for custom silicon. That leads directly to way more complicated architectures, which then drastically multiplies the need for verification, structurally driving a massive surge in demand for Synopsys' EDA and simulation tools. And you can literally see this playing out right now with the biggest tech giants on the planet. Hyperscalers like Amazon and Google, companies that used to just buy off-the-shelf chips, are now increasingly designing their own custom silicon in-house. So the smart investor doesn't sit around trying to guess which specific AI chip is going to win the race. Instead, they zoom out and look at who sells the essential tools required to design all of these competing chips in the first place. But hold up, just because everybody wants custom silicon doesn't mean Synopsys automatically reaps all the rewards. They've got to navigate some very real challenges here. They're dealing with heavy customer concentration, and they absolutely have to maintain their pricing power, even as semiconductor R&D budgets face tightening. The big question is, can they lock in those long-term, highly lucrative licensing structures, or will fierce competition and shifting budgets force them to compromise? Now, if we just step away from all that complicated accounting noise for a second and focus purely on the cash generation, the picture clears up beautifully. Synopsys is targeting roughly $2.8 billion in operating cash flow, with incredibly lean capital expenditures of only around $225 million. That leaves us with a staggering $2.6 billion in targeted free cash flow for fiscal 2026. And cash, as they say, doesn't lie. Alongside that ocean of cash, management has issued their earnings guidance for fiscal 2026, zeroing in on a midpoint of exactly $15.07 in non-GAAP earnings per share. This is the single number that brings all of our clues together. It represents the increased scale, the Ansys integration, and the surging AI demand, all wrapped up into one expected profit figure. This is our ultimate baseline for testing the valuation. But hey, before we rush out to blindly price those $15.07 of earnings, we absolutely have to talk about the risks everyone else seems to be ignoring. Because every investment thesis has a breaking point, right? What if there's a sudden freeze in AI capital expenditure from the big hyperscalers? What if the broader semiconductor cycle takes a nasty downturn? Plus, we can't ignore the very real threat of integration hiccups with Ansys, sudden changes in export restrictions, or just the simple, painful reality of valuation multiple compression. Which brings us to one of the most critical distinctions you can make in investing. You must never, ever confuse an excellent company with a good stock at today's price. Synopsys can be an absolutely stellar business, a major beneficiary of AI, and a total cash-generating machine, while simultaneously being a terrible investment if you end up paying the wrong multiple for it. So we have to stress test this valuation across a few different scenarios to really confront reality. In a pure bull case, sure, AI spend stays robust, the integration is flawless, and the market happily pays a premium. That's great. But the base and bear cases are where we actually earn our keep. If growth simply normalizes and the valuation multiple shrinks back to a moderate level, does this stock still give you an attractive return? And in a bear case, how much could this thing fall even if Synopsys remains a fundamentally solid company? So, tallying up everything we've unpacked today, we firmly confirmed that incredibly strategic EDA positioning and that gorgeous $2.6 billion free cash flow target. We've also shined a light on the material risks surrounding the Ansys integration and geopolitical export restrictions. We know the company, we know the growth drivers, and we understand the AI tailwinds. That leaves exactly one unsolved mystery left on the board. Recently, even after raising their outlook, Synopsys stock actually took a slight dip in the market. And that divergence between fundamental business strength and the market's reaction poses the ultimate question. What price are investors truly willing to pay for that $15.07 of earnings? Because that exact same earnings number can be an absolute bargain at one price, perfectly fair at another, and dangerously expensive at another. So looking at Synopsys right now, you really have to ask yourself, has this incredible AI engine finally gotten cheap enough to buy, or is the market trying to tell us something else entirely?